Good morning and welcome to Real Estate Economics weekly webinar series. Real Estate Economics is a leading provider of residential market research, development consulting, and online research tools based in Irvine, California. Weekly, we present a webinar covering anything from the entire nation to individual states down to MSAs or even certain counties in some cases. They're posted to YouTube every Wednesday at 9 a.m. Typically, the webinars are posted into several files, so if you're trying to listen or would like to listen to the whole series, make sure you get all of the files that go with that particular webinar. Today we'll be presenting Arizona, covering Maricopa, Pinal, and Pima counties. Let me briefly address our upcoming schedule. Today is Phoenix, Arizona. A week from today will be Seattle, Washington, also posted at 9 a.m. And 2 weeks from today it'll be Texas. As you can see on the screen, please go to www.youtube.com /Real Estate Economics. This is part one. We usually provide a little bit of history when we're covering a particular market area, so you can see what condition the market's in for the on the ground today, if you will, and then we will go into forecasts and our 5-year housing model looking forward into conditions in the years to come. As I mentioned earlier, this is Pima County, Maricopa, Pinal. That will cover Tucson, the greater Phoenix area. Let's start with a little history for years 2008 through 10. Our housing transaction report product, which can be downloaded from the internet for any size of an area. You can do a state, you can do a county, you can do a city, a zip code. If you really want to become particularly granular on an area, you can go right down to a lot and block area. And it shows a map like this that shows transaction types for residential real estate sales. The blue dots are conventional resales. Those usually consist of seller to seller, normal everyday seller to seller sales, but can include short sales because there is no notice of default on the property. Green dots and the green square in the legend is for new home sales. That's from a builder subdivision. The orange is a foreclosure. That is an owner back to a lender. And the yellow is foreclosure sales. That is a sale by a lender of a previously repossessed unit. So you can see in both of these market areas in 2008 the economy is performing pretty well, employment is good, credit is available. This is prior to the credit crisis. So businesses, builders can get loans, and quite frankly homeowners are getting too many loans. So there's an abundant market activity, just a few scattered foreclosures and foreclosure sales at this point in time. You can see in the green dots in both market areas that there's new builder sales. Starting to go out to the outlying areas, the secondary and tertiary markets a little bit, but still fairly good new home builder activity. Let's come forward one complete year to March 2009, and you can start to see the distress take place. Now all of a sudden we have many more foreclosures, a few more foreclosure sales. Many of the lenders, it does take time to ramp up the staff and the infrastructure, internal infrastructure, to process the repossessed homes and to get them turned around and back to market. So it has taken our lenders a little bit of time to adapt to the new market conditions going forwards. Again, you can still see some new home sales in both market areas. At this point in time, we've started to really experience a credit crunch. The stock market is having a very bad 6-month period, and confidence is really being shaken here. So you can see a transition or a trend change just in the colors of the dots in this particular slide. Let's come forward one more full year till March 2010. That's essentially a current time period as far as this data is concerned. And you've seen a huge resurgence in resales, particularly on the Maricopa Pinal side. Now the market, little communities and even the whole market area, you can hardly see any names because there's so many of the blue dots in the resales. The resale volume has really picked up here. What we would typically see is that volume will trough before pricing will trough. So in this particular market area, at least on the Maricopa Pinal side, the volume has troughed and pricing is plateauing at a somewhat low level and starting to even show a little bit of appreciation. On the Pima County side, we have not yet seen the trough in volume, and so it's unlikely that the bottom in prices is in there yet. If you look at the price trends in both of these markets, Pima County's on the left, beginning in March 2008, is the bar on the far left, March 2009 in the center, and 2010 on the right. To put a little bit of historical perspective here, on the Pima County side, the average price in March 2008 is $246,560. 1 year previous to that, it was $265,952, and almost the same 1 year earlier in March of 2006. So the price peak is really in here in the 07 period, and by 08 we're starting to see some price declines, declining all the way to 109.54 in the center bar in March of 2009, and now down to 104.29. As we stated earlier, it's unlikely the bottom is in this market. On the other side, the Maricopa Pinal side, the current price is $277,915 with a value ratio of 136. If we look back to the previous years, in 2007, March 2007, the average price is $331,064, which really was a peak during the course of that year in this particular market area in 2007. The average value ratio at that time was 168.18. So in 1 year we've gone from 168 per square foot to 136, and then the damage really begins to become profound with a decline to 88.45 by March 2009, and rebounding a little bit here, 94.12. So we think in this market we've seen a trough in sales volume, which is at least leading to some initial price stability. This particular graph shows price trends. As you can see on the left, Pima County's showing year over year large declines in conventional resales, large declines in new home sales, but steady to increasing foreclosures and foreclosure sales. On the Maricopa Pinal side, you can see from 09 we had 2843 conventional resales to 5436. Huge increase there. New builder sales, shown in green, tend to be a little slow, and they're languishing at about 800. But you can see the foreclosures, and more importantly, foreclosure sales are coming up dramatically. This is signaling that investors, remodelers, home flippers, these sorts of people are busy culling the distressed inventory and pulling out the best homes, taking homes that are close to schools, close to employment, that have good fundamentals, and are renting those out, in many cases for a positive cash flow, and putting those homes back into the housing stock and out of the distressed inventory classification. This shows a distribution of sales by price range. As you can see, during the course of the market disruption, prices migrated into much more affordable price levels, and so did volume. Particularly in the right-hand column, Maricopa Pinal, you can see huge increases in volume in the purple, the most current period, and also just a little bit of uptick in the higher price ranges taking place at this time. That's the end of part 1 of this series. In a few moments we'll begin part 2. Make sure, if you want to hear them all, that you download them all. They're not necessarily in a given order, but it might be helpful to have continuity to take them in that approach. Again, part 1 of 4, Real Estate Economics Weekly webinar on the Phoenix, Arizona area.